Hi, Wednesday night, 8 p.m. Eastern means Taxes and Retirement Live. I am Andy Panko. Thank you for joining. For those of you who don't know me, I am the one of the moderators of this lovely Taxes and Retirement group. So thank you. Welcome. Tonight we have a mailbag edition. These are always fun. So this is where folks can ask me anything. For those of you watching live, you can ask, just pop a comment, question as a comment, as a reply to this post that you're looking at right now. And I will see it. So let me make sure comments are working. If anyone, okay, I see someone has liked this video. It looks like comments are working, I suppose. There we go. Yep. Greetings and salutations, somebody says. Hello there. So yeah, mailbag. Just dump your questions in. I have one question that was sent in advance that I will answer first, but otherwise this is just a free-for-all. However many or a few questions you all have, I will be happy to answer. Don't hold back. Doesn't need to be necessarily taxes and retirement related. Whatever you want to ask, feel free. Before we get started, what do I do first? Do I do dad jokes? Yes, I do dad jokes first. Tonight's dad jokes for the evening are, find them. Here's something for you audio nerds, techno nerds. What happens if someone slaps you at a high frequency? It hurts. HERTZ. Wish I remember more about science, and I don't even know what field of science that was. Amplitude and waves and stuff like that. That probably has something to do with hertz, I guess. Those of you that know this stuff are probably cringing at my ignorance right now. Here we go. I got home from work today to find my kids have been on eBay all day. If they're still there tomorrow, I will lower the price. You get it? So they can be sold faster. My kids are on eBay. And finally, hold on, I'll queue up my little friend for this one. All right, I'm ready. My wife yelled at me, "Are you even listening to me?" I said, "That's a funny way to start a conversation." You get it? Because I wasn't listening, so I thought she had just started talking when in actuality she's been talking for a while, apparently. That happens in real life, sadly. Okay. Finally, before we get going, the disclaimer is this video is only general explanations and education. It is not specific tax, legal, or investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor, which I am not. I am just some person on Facebook answering random questions to the best of my knowledge and abilities, and hopefully the answers are correct, though I cannot guarantee they are. If I don't believe it's correct, I obviously won't say it, but use all this information at your own risk. All right. Comments, questions. Gratin and salad tasting, says Cody. Man, delicious. Sounds delicious. Alrighty, so first and only question I have so far. So better be some of you with some questions to dump in here. This could be awkward otherwise if I got to hang up on you all in 5 minutes. For Mariel Sitman, a lengthy Social Security question, but stick with me. It's regarding the Windfall Elimination provision, otherwise known as WEP, W-E-P. See if I can sum this up. So person turns 70 this year and will begin Social Security. Person currently receives a government pension. These are all sample amounts of about $10,000 per month, of which $9,000 per month is from non-Social Security work. Person was a firefighter. And the remaining $1,000 per month is from government work in which Social Security was paid. So let's pause here for a moment. For those of you who do work or have worked, chances are you worked at a job where you were covered by Social Security, which means you had Social Security taxes directly deducted from your paycheck. If you worked for someone, you paid half the amount of your required Social Security taxes. Your employer paid the other half on your behalf. If you work for yourself, you pay both parts. You're the employer and employee, and you pay the full freight, which is, I should know this off the top of my head, 12.4%, I think. So you pay 6.2 as employer, as employee, your employer pays 6.2, subject to a cap. There's an annual wage limit on which you pay Social Security taxes. Beyond that, you don't pay any more in, neither is your employer. So anyway, so most jobs in the U.S. are in the Social Security system, which means you have to pay Social Security taxes out of your wages. Some jobs are not. They're what's called not covered by Social Security. Most commonly, these are public sector jobs like teachers or municipal employees, firefighters in this example, police officers, things like that. I know, for example, like California police officers, they I don't know if all towns are like this or most of them, but they do not pay into Social Security. They get the CalPERS pension, fairly generous state pension, but they do not get Social Security, which means they don't have Social Security taxes withheld from their paychecks. So some jobs you don't pay in, some jobs you do, and regardless if you get a pension from either, or not regardless, but depending if you get a pension, the pension you get may reduce the Social Security you're otherwise eligible to receive if the pension you get is from a job where you did not pay into Social Security. So let me continue on. This will make more sense as I keep rolling. Okay, so $10,000 in total pension, $9,000 from a job in which Social Security was not paid, and $1,000 from other work in which the person did pay into Social Security. A person also has some other jobs outside of those two government jobs where those other jobs the person did pay into Social Security. The person only has a total of about 10 years of paying into Social Security. So let's pause there again. So what's the significance of 10 years? Well, in order to be covered or eligible for Social Security, let's just call it that. In order to be eligible to receive Social Security, you need to have 40 credits worth of covered earnings. Now, I forget the exact amount per credit, but a credit is basically, it's like $1,500, give or take a little. It changes every year with inflation. But if you earn more than $1,500 in a quarter, you get one credit, basically. So do the math. If you're working 10 years, that's 40 quarters. So long as you make, I'm rounding, roughly $6,000 a year, again, because one quarter is $1,500 roughly. I could be off by $100, give or take. As long as you make $6,000 a year, if you work for 10 years, you will have met 40 quarters of payments of coverage by Social Security. That makes you eligible for a benefit. Your benefit may not be large, but at least you got your foot in the door to get yourself a Social Security benefit eventually. So that's the significance of 10 years. The assumption is the person worked at least 40 quarters in Social Security terms and is eligible for a benefit. Right, moving on. The Devin Carroll has a great, he's an advisor. Social Security is really his bag. He's got a phenomenal YouTube channel. He's got a great website with lots of tools. So he's got a calculator on his website. So this person, Mariel, said she used the WEP, WEP calculator on Devin's website. And it said that the monthly Social Security benefit without any WEP adjustment is, let's call it $1,100. But with the WEP adjustment, it's lowered to $650. I'm rounding. Question: should the WEP adjustment, the WEP reduction of $400-something, $450, be lessened by the fact that 10% of the total pension amount of dollars received by this person was from work covered by Social Security? I'll pause it there. So a little thick to think about, but ultimately, no, Mario. It's already properly reflected. So to sum up what WEP is and how Social Security works, and man, this can be a topic all by itself. We can fill an hour on this. The way your Social Security benefit works is, let's assume you worked in Social Security jobs your whole life, meaning you did pay into Social Security. What happens is they take your highest 35 years of earnings. Now, it's more complicated than that. They'll look at all years of earnings prior to the year you turn 60, and they'll index it. They'll inflate it up to the year you turn 60 to account for changes in wages since then. So they first index or or inflation adjust all your wages up through the year you turn 60. Then they take the highest 35 of those inflation adjusted wages. Divide that by 420, I think is the math, and that's your average monthly index monthly Social Security earnings, if you will. That then gets run through this formula, and this is where stuff starts to get even trickier. This formula breaks up that average monthly Social Security earnings into 3 buckets, and I forget the cutoffs, but they're called breakpoints. Each bucket or breakpoint has a percentage applied to it. So the first, I'm completely making this number up, I forgot what they are. The first $1,000 of benefit is you get 90% credit of that towards your Social Security. The next slug of money, you get 32% credit, I think. The third chunk, you get 15% credit. So the gist is Social Security is never meant to be a complete wage replacement. But for those who were lower wage earners, it does replace a larger percentage of your wages than those who were higher wage earners, and that's by design. And that's through the way this formula is. Again, the smaller your wages are because of this formula, the more of them you end up getting, or the closer to 100% of that you end up getting as Social Security. The higher your wages are, the smaller percentage that is replaced because of this tiered formula. Man, I'm getting off topic here. But what this WEP, windfall elimination provision, does is it says Social Security wasn't meant to make people rich. It wasn't meant to be wage replacement. It was meant to be a minimum backstop of income to help prevent complete destitution. For folks that worked a non-Social Security job and potentially get a healthy pension from that, and then separately worked a regular Social Security job and didn't work a long time, so it looks like their total earnings are going to be small, the Social Security formula will give them a larger replacement value of their Social Security wages on the assumption that they didn't have that government job that's giving them a nice pension. So they decided that that's kind of unfair and against the spirit of what Social Security was intended to do, again, be a backstop of minimum income. So they figured if you already got a chunky pension from a job in which you didn't pay into Social Security, well, we're going to reduce your Social Security benefit because you already have decent enough money from this government pension. So the WEP formula, the way it works is it takes whatever your Social Security benefit would have been, and it tweaks that calculation formula. Remember I said the first slug of money in your average Social Security earnings, you get credit for 90% of it? Well, the WEP formula will knock it down to only 40% of it. So long way of saying, Mariel, that the fact that this person paid into another government job that did pay into Social Security and had another non-government Social Security job, that's already properly accounted for in the person's base Social Security benefit. The WEP reduction is what it is based purely on the pension from the job in which the person did not pay into Social Security. Man, I'm confusing myself saying this. So hopefully I answered the question, but the point is no. Assuming Devin's calculator on his website was programmed correctly, which I assume it was. No, you shouldn't expect an additional adjustment or tweak to the WEP formula because the starting benefit already includes the job at the government where he did pay into Social Security. I'll leave it there. It's just fun fact: the WEP, the windfall elimination provision, cannot eliminate your benefit completely, your Social Security benefit completely. It can reduce it, and it can reduce it by no more than, this is where formulaic comes into play. It's a few $100 max, or half of what your non-covered government pension is. So long story short, whatever your Social Security benefit would have been, it won't get reduced to zero, but it can get reduced by some amount, potentially a few $100 because of the windfall elimination provision. All right. Like I said, this could really be its own hour that warrants slides and examples because this is a thick topic. For those of you who are interested, though, Social Security does have a lot of great info about all this stuff. And let me just share with you. I pulled up, just Google Social Security windfall elimination provision, and you'll find this, or you'll easily find a link to this. This is the, I think they call it their fact summary or whatever. They have these like 2-page little handouts about various aspects of Social Security. This explains what the windfall elimination provision is. It explains the formula and how and why they tweak it to recalculate your benefit to account for WEP. And it also explains the ways you can get WEP potentially reduced or eliminated. So if you have at least 30 years of substantial earnings in a job in which you did pay Social Security, you won't be subject to WEP at all. Now, do the math. It may be hard. If you had a 20-year career at a government and then you had a 30-year career in a non-government position, that's 50 years of work. That puts you into your 70s, most likely. So a lot of people may not have 30 years of substantial Social Security earnings if they also have a WEP eligible or a WEP-related pension. Anyway, so check that out. Just Google Social Security WEP, W-E-P, and you can ultimately find this. All right. That was a doozy. So let me go move on now to other questions. Thank you for that, Mary. I hope I did that justice enough. Lori, my deceased parents have dozens of unclaimed items in the missing money state list. I'm neither an executor nor representative. My sister was executor, and she thinks that we have to refile 35-year-old tax returns. I'm going to try to claim it as a child of them. It's been 35 years since my mother died and 25 for my father. I'm certain that the IRS doesn't work that way. I'm okay with paying taxes on anything that I collect. It's easily over $10,000. Any idea how this works? No. I could be wrong, but I don't know why refiling old tax returns and unclaimed items are related. I guess it depends on the nature of why it's unclaimed. If it's unclaimed because your parents didn't file tax returns and therefore didn't claim refunds for something, that's a different story. Because after 3 years, like if you're entitled to a refund on your tax return, you don't have to file a tax return if you're due a refund. It's in your interest to, so you can get that refund. But if you don't, IRS isn't going to chase after you and say, "Hey, file a return so you can get your money back." No, but after 3 years, you lose. You're right. You basically waive the right to get that refund. So after 3 years, any refund your parents would have been due are gone. No one's getting those back. So this brings me back to, I don't know why your parents having unclaimed items or monies are warrant you or someone else having to file tax returns. So sorry, Laurie, but I don't know. Without knowing more info, I'm not quite sure the answer here. I don't know why tax returns are related to getting unclaimed assets. If you make a sizable Roth conversion, do estimated federal and state taxes need to be paid in the quarter in which the conversion is made to avoid an underpayment penalty? Oh man, hold on. Let me open up that can of worms. Maybe. I'm going to do, I think it's next month. Is it next? What month is it? It might be this month. 1, 2, 3. In 3 weeks, I think I'm going to be doing a deep dive. Yeah, I think so. A deep dive topic on this live about quarterly estimated payments versus withholdings. There's multiple ways you can pay taxes. It's always safest and cleanest and easiest to pay taxes through withholdings, which is and there's only a few sources of income against which you can do withholdings. Paychecks from W-2 work, annuities, Social Security, pensions, life insurance payouts, maybe. I'm drawing a blank. There's 1 or 2 others, but those are the biggies. A withholding is when the payer of the income, so your employer, for example, you get a paycheck. Your employer withholds taxes. Those taxes are paid straight away to the U.S. Treasury and/or the state taxing authority in whatever state you live in. Withholdings are better because there's no timing element. Whether you make your withholdings January 1st, December 31st, or any combination of days in between, it's all treated as if you pay those withholdings equally throughout the year. Whereas with estimated payments, they are recognized in the quarter in which you pay them. So you can't just make a big fat estimated payment at the end of the year to cover your whole year's tax obligation, because the IRS will have been expecting you to have made, estimated payments throughout the year, not just at the end of the year. So withholdings you can make whenever. Estimated payments need to be in the quarter, ideally in which you had or recognized the income. Now, this is where things get tricky. So depending how much you're already withholding, if that's going to cover enough of your year's tax obligation, inclusive of the conversion, no, you don't need to make any estimated payments to avoid underpayment penalties. If you're not already withholding enough, then yes, you do need to make estimated payments to withhold underpayment penalties. Now, there's 2 ways you can do it. If you know ahead of time for the year what your total income is going to be, you can estimate your annual estimated payment, break it up into 4 even chunks, and pay those equally throughout the 4 tax quarters. Or you can pay the estimated tax in the quarter in which you recognize the income or did the conversion in your case. That's going to take a little more work on your tax return. You'll have to do what's called, quote unquote, annualize your income on Form 2210. And annualization, the annualizing of income, is what allows you to tick and tie the quarters in which you recognize income with the quarters in which you paid estimated taxes. Because if you don't annualize, again, it assumes that your estimated payments need to be like 4 equal chunks broken out throughout the year. There's more to it than that. Underpayment penalties can be avoided if you meet what's called a safe harbor, meaning you pay at least a certain amount of tax throughout the year. It doesn't need to be the whole nut, but it needs to be 90% of the year's ultimate total tax obligation, or 100 or potentially 110% of last year's total tax obligation. So let me stop there. You can see clearly there's a lot of twists and turns in this story. 3 weeks from today will be my deep dive into making with tax withholdings and or quarterly estimated tax payments and underpayment penalties. So good question, but painfully unsimple answer. Alrighty. Mary Sherman. I have a defined benefit pension coming to me in a couple years when I turn 65. It has no cost of living adjustment. If I take it early, I give up 0.5% per month for each month I take it before 65. I can also get 0.5% per month more on the 65 amount for each month I delay past 65 until 70. Should I look at this the same way as Social Security? In other words, to hold off as long as I can before taking it? I do have a traditional IRA that I could use instead, but I'm not sure that it would be as good a deal as it is for Social Security, where the cost of living adjustment is compounded, but there's no cost of living adjustment on the defined benefit pension. Depends on a lot of things, Mary. How conservative are you? How much guaranteed income do you want and need? What are your expenses going to be throughout retirement, specifically your minimum basic expenses? How much other assets do you have? So there's a few ways to look at this, and you can see why this is a difficult analysis and decision. If let's just assume you have $5 million and you live modestly, you only spend 50 grand a year for the rest of your life, then it frankly doesn't matter what you do. There's no way you're blowing through that money shy of lawsuit and someone taking it from you. Even if you just park it in coffee can in your mattress and you lose money to inflation, you're still going to be okay, because 50 grand out of 5 million, I can't do the math that quick, is going to be what, 20. That's like 100 years. Is that right? Yeah, 100 years worth of $50,000 withdrawals if you got 5 million. No, that can't be right. 2, 10, yeah, 10, 20, 50 years. What? No. Anyway, I'm stumbling on basic math. 10, 50, 100 years. Yeah, 100 years. So no, in that case, it doesn't matter. You're not going to run out of money. Who cares what you do? If you don't have $5 million, or you spend a lot more than 50 grand a year, and there is risk of potentially running out of money, then you have to consider. Let me just take this off. How much of my income do I want to be in the form of like guaranteed, steady paychecks for life? If you want more as opposed to less, then yes, then maybe you keep delaying the start of your pension, even though you won't get a cost of living adjustment. Maybe you keep delaying it. In the interim, you will have to spend down more of your portfolio, but the payoff will be that much larger of a pension. So just do the math between Social Security and this pension. When you do start them, how much guaranteed income is it going to be, and what is that compared to what your expenses will be, specifically your sort of basic minimum expenses? So you can kind of view it like this. Even if and when your investable assets eventually deplete, in a worst case scenario, if your Social Security and pension combined are enough to cover at least your basic expenses, well, you're in a good spot. You're not going to have to worry about living in complete squalor. This is the idea of the quote unquote minimum dignity floor. For those of you who follow Jim Saulnier and the Retirement IRA show podcast, that's his approach. Figure out your minimum dignity floor, which is the basics you need to live not just a complete non-squalor life, but like a decent life. And ideally lock up those expense needs with guaranteed income sources from Social Security, pension, and or annuities. Above and beyond that, the rest of the money is fun money. If it were to deplete, you'd still be okay in theory, because you have this guaranteed paycheck to cover your basic expenses. So that's definitely one thing to consider. What are your basic expenses relative to what your Social Security is? If Social Security won't cover it, then yes, then maybe consider delaying the pension to squeak a little more out of it. The flip side of that is for people who are firm believers in the markets, and the markets can do no wrong over the long term, and or people who are a little more risk takers, or less risk averse, I should say. They may be of the view that, no, why would I spend down my portfolio? I'd like to save it. That's going to grow larger than what my pension is. So I'm going to take the pension ASAP and just invest my portfolio, because the portfolio should do better in the long term than my pension will be. So a very difficult decision. If you want to try to put some numbers to it, there's financial planning software. There's retail focused software from a place called New Retirement. For $100 a year, they have a pretty robust DIY end user focused financial modeling software. Or if you do work with an advisor or planner, he or she should be able to do various scenarios and projections for you, figuring out take pension early, not take pension early, and see what the anticipated impacts are. But frankly, we really don't know. It's going to ultimately come down to what do the markets do with regards to your investable portfolio. Fast forward 30 years, if stocks and bonds end up doing really well, then the right answer would have been, the better answer probably would have been, no, take the pension early, keep your money invested. Or if the world craps out and Russia starts a nuclear war with the rest of the world, that's probably not good for the financial markets. And maybe looking forward, the better bet will have been to get as much pension as possible. Therefore, that would lean towards you delaying your pension. So it's not a simple analysis. And a lot of it is sort of subjective and based on your own emotional views towards risk and how risk averse you are. If you simply will sleep better by having that much more of your income come from a guaranteed pension that won't stop, then maybe that's the right answer for you. Delay the pension as long as possible to get as much as you can from it. Other folks, that may not be the right answer for them because they may not worry about losing sleep with their money invested in the market. So, man, good questions tonight. So yeah, hopefully that gave you some guidance. I mean, there's no way to answer that question with 100% clarity, especially on a Facebook thing like this, but those are at least the things to consider. Going back to Lori, so the missing assets, the lost funds are stock dividends. Stocks that pay dividends or actual dividends that were paid, say, in an account somewhere. But still, either way, I'm not sure why tax return would come into play. Your parents either owned the stuff or they didn't. If they did, and it's an unclaimed whatever it's called, I frankly don't know what the process is to get it or to prove that you were the next of kin or at least their the declared beneficiaries on their wills. I've never actually gone through the process myself or with anyone of trying to go claim unclaimed stuff. So I frankly don't know. But again, I'd be surprised if a tax return is needed, especially something 30 years back. Anyway, that could be wrong though. Facebook user, when is interest paid for a home equity line of credit against your primary home tax deductible? If you used it, for example, to buy a new vehicle until your old one is sold, would that be deductible? What about if you use it for improvements to a rental home? Would that be deductible against rental income? So this changed. This changed with the Tax Cuts and Jobs Act of 2018, or started in 2018. So it depends. Under current legislation, what's deductible? Let's assume you're starting a new loan, a new mortgage or a new home equity line of credit. What is deductible is a first mortgage, the interest on your traditional first mortgage for your primary residence. That's deductible. Interest on a home equity loan, I forget the exact wording. I'm not 100% certain on this, but if I remember correctly, interest on a home equity loan is only deductible to the extent the borrowings were used to build, acquire, or improve your primary residence or something along those lines. And even then, I think there's a cap on how much interest or at least how much loan proceeds or something like that is actually deductible. But it's clear that unless it's related to your primary residence, no, it's not deductible. So if you borrow against a home equity line of credit to buy a car, the interest is not deductible. If you borrow against it for improvements to a rental home, now it gets hairy. Now it's a different story. The rental home, if you're renting it out for rental income, then it's functionally a business. And interest can be deducted as a business expense, but you wouldn't deduct the home equity interest on your own Schedule A with itemized deductions. Instead, the interest would be deductible on Schedule E, where you show the income and expenses of your rental. So there's something called tracing with interest. Even though the home equity loan may be secured by your primary residence, if the interest, if the borrowings against a home equity loan and therefore the interest on those borrowings is used to do something for the benefit of a rental home, then I believe that the interest is traceable to be a deductible rental expense on your Schedule E of your tax return. So yes, to answer that, I believe that would be deductible against rental income. Again, reported on Schedule E, not on Schedule A. Now, so that's under new legislation. Under old legislation, pre-Tax Cuts and Jobs Act, I could be way off on this, but I think if you already had an outstanding home equity line of credit and you had a loan outstanding, even for a car you purchased or something, I think that outstanding loan or draw for the car purchase will be grandfathered such that the interest continues to be deductible, but I don't know that for a fact. I just vaguely remember that being the case, but I can be wrong. Good question. Facebook user has a 401k Roth and a health savings account. Would this mean my W-2 at the end of the year would have different amounts on gross wages? And I guess the end got cut off. So yeah, I think I know where you're going with this. So yes, if you look at your W-2, box 1, 3, and 5 will have different numbers. Box 1 will say, I think it says taxable wages. Box 3 will say Social Security wages. Box 5 will say Medicare wages. All three can and often are different. Box 1, the taxable wages, is effectively your gross wages minus all tax deductible things like traditional 401k contributions, like HSA contributions made through your employer, like medical benefits withheld from your paychecks to pay premiums for your medical insurance. That's tax deductible. That'll all be net reflected in box 1, taxable wages. Box 3, Social Security wages will be your gross wages, basically. HSA deductions, I think, are the only thing that reduces it. There may be others, but practically it's really just HSA deductions. So that'll be your Social Security wages, again, capped at the annual Social Security wage limit. I forget what it is this year, $150,000 maybe, give or take a little. And box 5, Medicare wages, will again be gross wages reduced only by HSA contributions and maybe one or two other things, but generally just HSA contributions. So yes, your gross wages will be different from taxable wages and potentially different from Social Security and Medicare wages as well. The 401k contributions you make don't get you any tax deductions, so that won't impact things. Your gross wages will equal your net wages, your taxable wages, all else equal, if you make 401k Roth contributions. But HSAs, in most cases, will get you a tax deduction if you make those contributions through your employer, through paycheck withholdings. Can you give an example of the spousal Social Security benefit? The higher earning spouse being 3 years older than the lower earning spouse. For example, if the older spouse claims at 67, the younger spouse claims spousal benefits at 64, and then claims their own benefit at age 70. This is how it's explained to me, trying to make sure I am understanding this correctly. I understand that all scenarios need to be run, blah, blah, blah. Okay. So what you're mentioning can't happen, and I'll explain why. So sorry, let me back up. What are spousal benefits? Spousal benefits are simply for married couples, and even if you're divorced and were married at least 10 years, you can get spousal benefits. Spousal benefits are simply when the higher earning spouse starts his or her benefit, the lower earning spouse can get a spousal benefit off of the other spouse's earnings record. So at one extreme, let's assume only one spouse ever worked, the other spouse didn't. The spouse who did work starts Social Security benefits. The spouse who did not work can get spousal benefits, which are keyed off of half of the other spouse's primary insurance amount, which is the benefit that spouse would have gotten if they started benefits at his or her full retirement age. Confusing, right? So that's a fairly straightforward example. The spouse who didn't work and has no Social Security earnings on his or her own earnings history, because there is no earnings history, can still get a benefit off the working spouse to some extent. Now, where it gets tricky is if both spouses did work and the lower earning spouse is his or her own benefit going to be larger than what the spousal benefit will be. Again, the spousal benefit will never be more than 50% of what the other spouse's full retirement age benefit is or would have been. So the unless here's another wrinkle to this. Unless the spouse was born on January 2nd, 1954 or later, that spouse can't pick or choose. And this is why I said you can't do what you're mentioning. That spouse can't pick or choose taking just the spousal benefit and then later switching to his or her own benefit. That person will be what's called subject to deemed filing, that whenever the lower earning spouse starts any benefit, they will automatically be given whatever's highest available to them at the time, whether it's the spousal benefit or their own benefit. That's the benefit they're going to get. So in this example, they can't choose to take just a spousal benefit and then later start their own. If their own is already higher, they will get their own benefit at the time. Again, the cutoff was you need to be born before January 2nd, 1954 to do this pick or choose benefit thing. Another wrinkle to the wrinkles, that if your spouse is still alive, you need to be born before that date I just mentioned. If your spouse is deceased, different story. Then you can pick and choose which benefit you start without regard to when you were born. There's no cutoff for your birth date in that case. So that's a different story, which you didn't ask, and I won't get too into that because that's another rabbit hole that I can spend a lot of time on. So I don't have to answer your question, but I mean, no. I mean, this might answer your question. You can't do what you're referencing doing because the spouse who's 64 now would have been born after that cutoff date, the beginning of 1954. So that younger spouse can't do the picking and choosing of benefits. Unfortunately, he or she will get whatever benefits highest available to him or her at the time. Okay. I'm in the process of creating a revocable living trust. Can I put my son as a trustee and same time beneficiary? Thanks. Yes. Done. You can. Nothing saying you can't do that. David Foltz, when considering Roth conversions, are there thresholds where it is probably a good idea to do? For example, 1 million and above in traditional IRA. Oh man, I'm going to be, so I frequently write articles for a outlet called Rethinking 65. It's sort of advisor focused, but a lot of good content for regular, end users. And coincidentally, the article I'm working on writing, and it'll be out within the next few weeks, is all about the difficulty and futility of trying to predict and really put firm numbers around Roth conversion analysis and predictions and how much is beneficial to do versus not. Because there's so many, you all hear me say this all the time, there's so many variables that can and will change over time. And those variables can all dramatically impact the ultimate value you do or don't get and realize from doing Roth conversions. I mean, all else equal, yes, the larger the amount of tax-deferred money you have now, the more benefit you'll get from doing Roth conversions because it'll be that much less tax you have to pay down the road, right? But as far as rule of thumb or threshold, no. So just David Foltz, for example, $1 million in traditional IRA isn't that much tax-deferred money that you have to worry about if you don't have a lot of other sources of income. So you can easily, spend this down, fill up your lower tax brackets by taking IRA distributions. But if you are in a fortunate position where you already have a chunky amount of pension and or Social Security on top of it, such that the pension and Social Security are already crowding out your lower tax brackets, then sure, then maybe it makes more sense to start whittling down your traditional IRA now, even if it's only $1 million, because you're never going to have a better opportunity because you already have a lot of income from pension and Social Security. Now, don't lose the sight of the trees and forests. Don't lose be able to see the forest through the trees, or whatever that saying goes. Like Jim Saulnier saying, this is like pulling teeth from a baby. It's a good problem to have. If you have too much income from pension and Social Security that you're crowding out your lower tax brackets, and then good for you, a good problem to have. So, but no, it's a roundabout way of saying there really is no threshold or rule of thumb. And I'll be happy to share with you all the article after I write it about why it's so impossibly difficult to do any sort of like quantifiable analysis around the long-term value of Roth conversions. And I'm going to give examples of how you tweak a few variables just a little bit and it dramatically changes the outcome. So, but no, thank you for the question there. All right, what else we got? Ooh, looks like that might be it. So Vicky can finally see comments and see me. Yay, cool. I'm happy. Good. Looking forward to the article on evaluation of Roth conversion. Yeah, man, you all are going to be let down. I mean, it'll be very insightful in that it'll just go to show how impossible and difficult it is to put numbers to doing Roth conversions. Like I cringe. There's an advisor in another group. I'm in an advisor group who said, he freely does these like detailed Roth conversion projections and put in front of someone one time a report showing, look, you do this conversion plan, I can save you $300,000 in taxes over your lifetime. I was like, oh God, don't say that. Like, yeah, maybe that'll come to fruition. Maybe it won't. Maybe tax legislation will change or not change as much as we anticipate. Or maybe stock market returns will crap out for the next 10 years, such that the ultimate value and growth in the Roth isn't going to be as much as you're projecting now. Maybe you'll have less income than you anticipated from other sources, such that you'll be spending down more Roth IRA anyway. Maybe you're going to die soon and you're not going to have enough time to recoup all the tax you paid now and realize the benefit of conversions. There's so many big impactful things here that when you see the article, you can be like, wow, yeah, I get why Andy's not just dodging it and giving cop-out answers as to why he's not saying how much conversions I should do. Like, it really is that difficult to try to guess and figure out. Anyway, I'll stop there. But yes, I will share the article when it's done. Ooh, hi, Shauna. Just joined in progress. Welcome. Okay. Question. I have one traditional IRA. If I wish to name both a charity and people, can I trust the custodian to split the IRA for each beneficiary so nobody is combined with the charity? It's Vanguard. Or should I split the IRA into two to separate the charity? Yeah, I mean, you should. So you can have a single IRA and just name, let's say on the beneficiary designation form, you just say charity XYZ gets 50% and person ABC gets 50%. There's no reason why Vanguard or any other custodian, shy of gross negligence, shouldn't honor that, split it up, and have both recipients, the charity and the person, open up inherited IRAs for their respective 50% share. And I mean, not to say stupid errors or careless errors can happen. So if you want to sleep better, sure, maybe you simply open up two IRAs, put half in one, half in the other. This one is named solely with the charity's beneficiary. This one is named solely with the person's beneficiary. That definitely solves it with no ambiguity. But I really would be surprised if, assuming you have your beneficiary form properly filled out, stating 50-50, I'd be surprised if Vanguard or any other custodian botches it or doesn't honor it. I mean, they can't not honor it. Can they mistakenly mess it up? Sure. But I don't think they have any grounds for choosing, consciously to not honor that split. Okay. Question. Can you explain the benefits or not for those who say they want to convert it all? Yeah, this, it depends. It definitely depends. So for example, I forget the specifics, but I had a call with a potential client like some point earlier last year. He already did a good job converting and had, I want to say, like $300,000 left in a traditional IRA. We'll have a pension, we'll have Social Security, and it has like taxable brokerage accounts and Roth accounts. Basic back of the envelope math, he doesn't have a big tax problem. I forget the exact analysis, but quick discussion was like $300,000. You don't need to worry about converting this. Not to say it's not going to hurt if you do. Not to say it's guaranteed to help if you do, but $300,000, you don't have a big honking looming tax problem. So don't sweat it. So that's one example of no, don't convert at all. If you got a few $1,000,000, again, you don't need to convert it all necessarily, but you probably want to try to whittle it down if you can within reason. Now, this sort of is a backwards answer to the question, but there are times, or there is justification for why you wouldn't want to convert it all. This is also situation dependent. So again, the answer is it depends. But one example is if you're going to be, you don't have large sources of other income, Social Security small, let's assume you got no pension and that's it, then why convert now? Even in retirement, you'll be in a relatively low tax bracket. You'll be able to pull out fairly sizable amounts from your IRA just to meet day-to-day living expenses, still in relatively low tax brackets, again, assuming you don't have much other income filling up those tax brackets. So that's one example of no, you don't have a problem. Just just take distributions from your IRA over time. No need to convert it now. The other example of times where it may make sense is long-term care. So, or even not necessarily long-term care, but like large medical expenses. The math isn't perfect, but fast forward 20, 30 years or whatever, your 80s, 90s, and you have significant spike in medical expenses. you have an IRA, you can take distribution. Let's say you have $100,000 in medical expenses. You take $100,000 out of your IRA, but you turn around and use it to pay $100,000 in medical expenses. Well, guess what? Now you have really large medical expenses, the majority of which will be tax deductible, because under current legislation, you can deduct medical expenses to the extent they exceed 7.5% of your adjusted gross income, along with other potential itemized deductions. So that right there, even though you're going to have a large IRA distribution, if you're using it to pay for large medical expenses, you're going to wipe away most of that taxable income because of the medical expense deduction. But the math isn't perfect because this gets a little complicated. Even though your taxable income is going to be low because of the large medical expenses, your gross income is still going to be high, which means it could spike your Medicare premium surcharges for a year because of that large $100,000 IRA distribution. So it's not a perfect solution, but still nonetheless, that is potentially a reasonably tax efficient way to use IRA money down the future is if you have large medical expenses. You can just take draws from that, and your taxable income will be reduced a lot because of those deductions. So just some food for thought. Again, there's really is no rule of thumb as to when it is or isn't good to convert it all or a lot of it. You have to look at your individual circumstances. Another reason you may not want to convert much, or you may want to be okay leaving sizable amounts of tax deferred money, is depending on your legacy plans, wealth transfer plans. If it's money you're not going to need most of, let's just assume, and you're going to leave it to your kids, and let's assume your kids are starving artists, they don't have a lot of income. If and when you die and leave the money to them, they're going to be the ones to pay tax on those IRA distributions. And if they, as starving artists with not a lot of other income, if they're going to be in lower tax brackets than you are now in retirement, it may be more tax efficient from a wealth transfer process to just leave the IRA while you're alive, give it to your kids, let them pay tax on it, right? As opposed to you converting it, paying tax on it now at a higher tax rate than your starving artist kids will be paying on it. So that's another situation-specific example where this is not an easy analysis of when does it make sense to convert and how much. Anyway, I know this doesn't answer any of your questions, unfortunately, for all you who are asking these, but hopefully at least, but by me just sort of like spitting out these thought processes, you can see how involved and complicated it is to try to make this decision about, do I convert, how much and when? And, there's lots of angles you need to take into consideration. In doing 2021 taxes, what would be the modified adjusted gross income limit for single taxpayer to pay their second tier of IRMAA increase? When I bring my paperwork to accountant, can he tell me what my MAGI will be for this year? Okay, so two-part question, even though you may not know it's a two-part question. First part of the question is, what was your 2021 modified adjusted gross income for purposes of Medicare surcharges? Simple. Your accountant may not know, because most people who only do tax returns, even if they're CPAs, may not think or be well versed in Medicare stuff. They know the tax return. MAGI is nowhere on your tax return. Specifically, the MAGI used for Medicare premiums, you will not find that measure of MAGI. It's indirectly, you have to calculate it in your head. It's simply just your adjusted gross income plus tax exempt interest, if any. So it's a real easy MAGI to figure out. So if your tax return preparer doesn't calculate it for you, you can easily do it. When you get your return done, look at adjusted gross income, which is, I don't have a 2021 tax return in front of me. I think it's line 11, plus your tax exempt interest, which I think is 2A. Simply add those up. That's your MAGI. Done. That's the first part of your question. Second part of your question is, what is the threshold going to be for IRMAA? We don't know yet. And this is why, because your 2021 MAGI is what dictates your 2023 IRMAA surcharge, if any. But the income brackets aren't known, or the 2021 income brackets won't be known until fall of 2022, unfortunately. We can guess what we think they're going to be. So we know, for example, that the 2020 income brackets for 2020, no, not even. Yeah, the 2020 income brackets for 2022 IRMAA The second band stops at $228,000 for married folks, $114,000 for single. There will be inflation on that. We don't know how much. Let's just assume it'll be relatively high because inflation's been running at like 7%. So add roughly 7% to those, and that's what the 2021 income brackets can be reasonably expected to be. But again, we won't know until fall of 2022 when they formally announce it, what the 2021 income brackets are for 2023 IRMAA payments. You with me? I just dropped a lot of different dates and years on you. But anyway, so yes, you can easily find out what your MAGI is for 2021, but no, we do not yet know what the actual income levels will be, cutoffs will be for 2021 incomes. Some people think it's better to convert everything. Maybe not a good idea. There's also a lot of personal subjectivity and opinions that go into this. Here's what I mean by that. While it can't be quantified, there is some level of inherent value in getting tax out of the way now at a known rate. Even if it ends up paying more tax now than you should have, there's value in knowing, you know what, if I convert everything to Roth, I don't have to worry about tax on this money again, period. I do not foresee any way possible the government will subject Roths to tax, at least not retroactively. Maybe going forward, they'll put the kibosh on Roths and you can't additionally contribute. But for money already in Roths, I cannot envision a world where they start taxing it. It will literally be pitchforks and lanterns, people marching, chopping off heads on Capitol Hill. So there's that. If you get at one extreme, all of your tax for money converted to Roth today, even if you're paying 50% tax on it between state and federal, maybe you'll sleep better because I do not have to worry about tax again, period. And if that value is really high, you know, that sense of not having to worry about it is really high for you, then yeah, then maybe that is the right answer for you. For other folks who aren't that concerned about it, you know, some folks just want to die fat and happy. I got $5 million. I know I'm not going to spend it down. So what if I end up paying a little more tax on it in the future than I could have today, or a lot more tax even in the future than I could have today? They may not care. They may not want to go through this exercise of doing conversions and projections and paying tax now. They may not care because it's ultimately not going to impact their financial life. So for them, no, the right answer may be not do any conversions at all. And other folks may be somewhere in between. You also have to factor in your own speculation about where you think future tax rates are going to go and how high specifically they're going to increase for you. Nobody knows, but some folks are convinced taxes are going to substantially go up for all of us, in which case, sure, getting more conversions out of the way now are going to be better than not. Other folks think taxes will go up somewhat, but not by that much. So they're not that concerned about doing conversions. The future will tell, you know, hindsight will tell us what the right answer was, but we'll only know that after we know what tax legislative changes actually happened, what financial markets actually did, how long you actually live. So it's really impossible to say. So anyway, yeah, some people think it's okay to convert, and for them, that may be the right answer, but a lot of that's going to be sort of emotional, subjective answers as opposed to quantifiable tax and dollar answers. So really tough. The charity on IRA used to limit all to take within 5 years. Oh yeah, this is in response to the other question. So if you do leave money to a charity, they need to fully distribute it within 5 years because they're not an individual. They're not a living, breathing person. But that's okay. Charities don't pay tax on this money anyway because they're charities. So even though the money's forced upon them within 5 years, they can't stretch out distributions. It doesn't matter from a tax perspective because they're not paying tax anyway. I just had another thought. Oh, one other reason, right, charity. One other reason why you wouldn't necessarily want to convert all of your tax-deferred money away is if you're charitably inclined and you plan on giving money away every year anyway. The most tax-efficient way to give cash is if you're over 70 and a half, is to give it straight away out of your IRA by what's called a QCD or qualified charitable distribution. That's simply where the custodian sends money direct from your IRA to a qualifying charity. The distribution does not count in your gross income. Therefore, you're not taxed, and it doesn't trigger off IRMAA or anything, you know, the Medicare surcharges, because the charity's tax exempt. They don't pay tax on it either. And even better, The qualified charitable distributions are the one thing that are allowed to take the place of required minimum distributions. So once you're 72 and need to start taking money out because of required minimum distributions, let's assume you don't actually need the money, but the government forced you to take it out anyway. Well, if you're charitably inclined, you can give away some or all of that required distribution in the form of a qualified charitable distribution where it's not tax-free to you and you get around having to take the RMD. So another reason to not necessarily feel the need to convert away all of your tax-deferred money if you're charitably inclined. Ooh, it's almost 9. Wow, cool. More questions than I thought. Initially, I was like, man, this is going to be 5 minutes and I'm done. So thank you all for these questions. If I just did a recharacterization of a Roth IRA contribution to a traditional IRA last week, will I get a 1099-R for this? When will it come? And do I need to file it for my taxes? No. You'll get a Form 5498. And this is why Forms 5498 often don't come until April. Because, so what Form 5498 is it shows contributions made to IRAs and Roth IRAs. So for example, because you're able to still do contributions to said plans up until you file your tax return, in theory, custodians shouldn't be issuing Forms 5498 until after April 15th, until after they know how many contributions you've actually made for the tax year. So 1099-Rs are only for distributions, not contributions. And in your case, what you did was you initially made a contribution to a Roth IRA. You want to recharacterize it to instead pretend as if it was a contribution to a traditional IRA. You can. The recharacterization isn't a distribution. You're not going to get, I don't believe you get a 1099-R for it. No, because instead what happens is the custodian makes it look like as if it was always a traditional IRA contribution in the first place. So there isn't really a distribution to come along with it. So you'll get a Form 5498, and that's why you won't get it until after April 15th, because the custodian needs to know what is the final resting place for this contribution that you made. Was it Roth? Was it traditional? Now they know you recharacterized. Now they know it was a traditional IRA. So some point from now forward, they will send you the Form 5498, and the IRS gets a copy of that, which is why, in theory, it's often good to get an amendment for your return if you're expecting a 5498. Even if you know with certainty what activity you had and what contributions you made, what if the custodian is wrong and reports something erroneous? Now you may have a bit of a headache on your hands. I mean, the right way is to get the custodian to amend it and fix it, but still, especially if you're cutting it close with recharacterizing and making contributions, I mean, you want to wait until the, give yourself as much time as possible to file your return until you know with certainty all your activity for the tax year is done. Okay, moving on. What's this? My husband currently has separate one. My husband currently has a Roth 401k and has a Roth IRA. He planned to retire next year. He planned to roll over his Roth 401k to his Roth IRA. Does he have to wait for the 5-year rule to get his distribution? He will be 66 next year. The Roth IRA has been open for more than 5 years. No, he is golden. When he retires and he does a rollover from his 401k, I assume he also has some pre-tax money in there, traditional 401k. What's going to happen is he will get 2 checks out of his 401k, one for all the pre-tax money, one for all the Roth money. That Roth check will get deposited into his Roth IRA. The pre-tax check will get deposited into a traditional IRA as part of the rollover. And no, since his Roth IRA has already been open for 5 years and he's over 59 and a half, he is golden. He does not have to worry about any waiting periods, 5-year rules, whatever, period, for the rest of his life, because he met the 2 golden ticket conditions. Over 59 and a half, first Roth IRA, funded more than 5 years ago, done. You do not have to worry about any rules. Any money he takes out of his Roth IRA from any point forward, regardless how or when the money gets in there, completely tax and penalty free, including this rollover from his 401k. Good question. If I made a large Roth in-plan conversion in January and make an IRS estimated tax payment to cover the conversion in first quarter, do I have to do Form 2210? If so, when do I do that form, now or when file taxes next year? Let me answer the latter part first. So if you did the conversion this tax year in January, then no, you don't have to do Form 2210 this year. It'll be with your 2022 tax return if you do it. Now, do you have to do it this quarter? No. So if the estimated payment was made in the first quarter and it does cover the tax obligation from this conversion, you'll be good. The IRS will always happily take estimated payments early in the year. They will not happily take estimated payments late in the year. Then they may ding you for not having paid early. But if you pay everything up front in the first quarter, all else equal, assuming there's not other sources of income that you're not deficient in paying taxes on, then no, you're not going to have a penalty because you duly paid on time. They'll gladly take money early. So you shouldn't have to do 2210 because you shouldn't be subject to an underpayment penalty if, again, assuming you did withhold enough through your paycheck for your rest of your income and you made a large enough estimated payment to cover the incremental additional tax obligation due to this in-plan conversion. My accountant never told me to keep track of pre and after tax money in my traditional IRA. Is there a simple way to figure out so I can do conversion to Roth, or should I just wait to 72 and do the RMDs? No, there's not a simple way other than backtrack. So other than backtracking through whatever records you have about after-tax contributions you made to your traditional IRA. Now, there's a few ways you can do that. You can look if you can look at your forms 5498. In theory, you should have gotten one of those every year you made any contribution to your IRA. No, that won't tell you whether or not that contribution was tax deductible or not. You'll have to look at that year's tax return to see if a deduction was taken. If it wasn't, there's your answer. Then that contribution was after tax. Now, the first year you have any after-tax money in the IRA, and every year thereafter, you continue to have after-tax money, you'll have to file, or you're supposed to file a Form 8606 with your tax return. That's what keeps track of how much after-tax money there is. So when you do take a distribution or do a conversion, you'll know how much of that distribution or conversion is non-taxable because some of it is going to be your after-tax money. If you know you only put a little bit of after-tax money in, like $100 or something, and you got, hundreds of thousands of dollars of pre-tax money, it's not going to be worth the headache of going back and trying to backtrack and figure it out. You're going to save yourself dollars of tax in doing it, and you're going to spend hours trying to recreate your history of after-tax deductions. So in that case, maybe you just let it go and forget about the fact that $100 of your IRA is after-tax money. Just, you missed out. It's worth the hassle, worth the savings, the hassle, just to forget about it. But if you have tens of thousands of dollars of after-tax money in your IRA, then yeah, you probably want to put the time and effort in to go through and actually figure out how much after-tax money is really in there, and then start this year going forward with filling out an 8606 to true up all the after-tax, accounting of after-tax money you have. So, going forward, taxability of distributions or conversions. All right, final question. It is 9:04 Eastern. I will wrap it here with Mr. Fultz. If someone rebalances their portfolio every 90 days, if there is a precipitous stock market drop immediately following rebalance, should they wait another 90 days before rebalancing again, or should they have a fallback threshold to do an earlier rebalance? Oh, man, great question. The answer is pick a plan and a rebalance cadence ahead of time and stick to it, period. Anytime you deviate from that plan, you are market timing. Market timing isn't good. I mean, maybe you get lucky and you get it right, but market timing is nothing more than speculation and gambling. So I personally, in my business, I do rebalances every quarter, middle of March, June, September, December. That's it. And or if someone needs a distribution or gets a large inflow of cash that really whacks out their allocations, then I'll rebalance at the time. But otherwise, I do it those 4 quarters, and that's it. If I do it more frequently, like for example, if I did it, last Tuesday or whatever day it was that Russia did the invasion, and stocks were down 3% at the start of the day, that's just speculation. I'm speculating by rebalancing that I don't think things are going down further. Right now, ultimately that day, stocks actually ended up fairly well, considering they were down 3% for the day. But by rebalancing off of your pre-agreed upon cadence, your market timing, you're saying if I'm going to rebalance now, that means I think stocks just hit a bottom. Well, what if they continue to go down even more? Then your rebalance now will bite you in the hiney because you will have bought more stocks just for stocks to further drop, right? So pick a plan, stick to it, whether it's every 90 days, quarterly, 6 months, or even 1 year, whatever it is, stick to it. Deviating from that is nothing more than gambling and market timing. Maybe you get it right, maybe you don't. Awesome news on the no 2210 if all tax obligations made by first quarter. Thank you, Andy. Sure. Yeah. So what happens is if you do overpay estimated taxes in the first quarter, what simply happens is the IRS, they'll look back at the end of the year and say, okay, here's your total tax for the year. Here's what it was based on the 4 quarters. And they will take that first quarter payment you made and they'll allocate only 1 quarter's portion of it to the first quarter. The excess you paid, they'll allocate to the second quarter. To the extent you have excess there, that'll spill over to the third quarter. So they will not ding you for paying more early in the year, but they will ding you for not paying enough and paying late in the year. Has there been any further talk about RMDs being moved to age 75 from 72? Further talk, no. There was meaningful talk at the end of last year in the Secure Act 2.0 is what it was dubbed, but I forget the exact proposed legislative name. But to my knowledge, no, that sort of stalled out given what's going on in the world and other political priorities. I suspect it may not get resurrected anytime soon, but who knows? I mean, I wouldn't be surprised. Legislation come out of nowhere hot and heavy, or it can just sort of die on the vine and never get anywhere. But as of now, no, still assume RMDs will continue to be required starting at age 72 until further notice. Oof, foreign tax credits. Yuck. Foreign stuff is not my bag. Do you know if foreign tax credits can be used to pay for U.S. capital gains? When you say pay, it depends what you mean. So any tax credits will reduce your tax bill. Whatever your tax obligation otherwise would have been, tax credits will reduce it. So therefore, indirectly, yes, any tax credit, including foreign tax credits, will lower the tax obligation you would otherwise have, which means indirectly, sure, these can be applied, if you will, to helping pay for capital gains taxes on stuff you sold in the U.S. So yes, indirectly. All right. Looks like that is all. What? Last one. This is it. Okay, I'm stopping here after this. Vicky. In early 2021, I did a pro rata direct rollover from a 401k Roth to a rollover IRA, Roth IRA. I'm over 65, first Roth IRA, 2013. Good. So you meet the 2 golden ticket conditions. Stopped working a couple of years ago. Last fall, I did a small conversion from rollover IRA to a new created Roth IRA. Do I have to wait 5 years to get the converted Roth? No. So regardless how many Roth IRAs you have, or even if you open new Roth IRAs 2 years from now, the fact that you are over 59 and a half and your first Roth IRA was funded at least 5 years ago, all your Roth distributions from any Roth IRA you have or will have from this point forward, completely tax and penalty free, period. To answer your question, no, you will not have to wait because you opened up a new Roth IRA. You are good. You met the golden ticket conditions. Alrighty, thank you all. Next week, Cody Garrett. I don't know if Cody's on tonight. It's the Cody Garrett show again next week. I don't know what topic he will be discussing, but he'll be going through one of his forms to review and digging into detail things to pay attention to in reviewing financial documents. The week after that, special guest Kevin Lyles. For those of you familiar with the Rock Retirement Club, which is a really cool membership group of retirees, retiree community, Kevin Lyles is the head coach there, and he's specializes in sort of like the finding meaning and purpose in retirement kind of angle. So he'll be joining me to talk about risks in retirement, and it'll be both financial risks and non-financial risks. So that should be a cool one. So that's 2 weeks from today. And then 3 weeks from today, as I said, is my deep dive into tax withholdings, estimated taxes, and underpayment penalties. Wild times. All right. Thank you all for joining. I will see you around the group. Take care.